Anda kembali menyaksikan Closing Bell. Presiden Amerika Serikat Donald Trump akhirnya menandatangani paket stimulus fiskal senilai 2,3 triliun dolar Amerika Serikat untuk menanggulangi dampak ekonomi akibat pandemi COVID-19 menjadi undang-undang pada hari Minggu 27 Desember 2020 waktu Amerika Serikat. Penandatanganan stimulus fiskal ini memulihkan tunjangan pengangguran bagi 14 juta orang Amerika hingga Maret 2021 dan mencegah juga penutupan sebagian pemerintahan federal. Sebagai informasi sebelumnya, Trump sempat menolak untuk menyetujui undang-undang tersebut. Resikonya pemerintah Amerika Serikat akan ditutup atau shutdown pada Selasa jika Trump tidak menyetujui undang-undang tersebut. Untuk membahas lebih lanjut terkait bursa global, khususnya juga usai Trump menyetujui stimulus jumbo, kami sudah terhubung dengan Thomas Hayes, Chairman and Managing Member Great Hill Capitals. Hello, Thomas. Appreciate it to discussing with this kind of a new issue. Finally, Donald Trump signed the state budget law worth $2.3 trillion, which is contain a large amount of $900 billion in COVID-19 assistance. This move will extend unemployment benefits to March 2021. With the signing of this law, the U.S. employed will receive $300 per week until mid-March. Assistance will also be extended to eligible freelancers and performance workers to receive the assistance. So, what do you think about these conditions, and how is the impact with this stimulus will boost the economic recovery in the United States in the middle of a new variants of COVID-19 in the United Kingdom?
Yeah, well, thank you for having me, Maria. It's great to be back. This is a very positive development for the economy and for the stock market. As you said, we'll have extended unemployment of $300 a week through March of 2021. But also, there's a $300 billion of PPP for small businesses, the loans that they did in the original CARES Act, which is essential for rehiring employees, keeping businesses afloat until more and more people get vaccinated and we get to herd immunity. And there's $15 billion in there for the airlines to bring back thousands of workers, even tens of thousands of workers that have been furloughed. And this is effectively a bridge to the other side for the next 3 to 4 months until we have full vaccinations in Q2 of 21. So this is a very, very positive development. Obviously, the stock market is up 68% off the lows, off the March lows. So we've moved quite a bit, and some of this was expected. I think it will be a net positive in the short term, and then maybe in Q1 of 2021, we'll consolidate some of these gains that we've seen over the last 7 or 8 months before making a leg higher. So on balance, the fact that this finally got through is a very good thing, Maria.
But many economists and lawmakers have called it $900 billion for coronavirus and package is inadequate. How do you see about that?
Well, I think the debate has been, there are a lot of people that have been hurt with their jobs and with their businesses to no fault of their own. And what President Trump was trying to do was to get $2,000 per person for lower income families as aid and stimulus to help them get through this time. And the bill only has $600 per person, which could be up to $2,400 for a family of 4, which is a decent amount of money, but it's really not much relative to the pain that some people have had if they were on frontline jobs or if they lost their business in, say, a restaurant, et cetera. And that was kind of the push and pull. President Trump wanted to get more money directly to the people, and Congress felt that that might be a little bit too much spending in the short term. So, maybe after the new administration, there'll be subsequent bills, but for now, the key was the timing to get something out right now, keep the government open, get money in people's hands today, and then see what to do in the future.
Okay. In the real right now, how is the conditions of business or spending in the United States right now?
The conditions for spending?
Yeah, for consumptions
Yes.
and consumption sectors and employments.
Yes. I think what we're seeing here is we got as high as 14.1% on the unemployment rate. People thought at that point in March and April that it was going to go to 20%. Instead, it's come down to 6.7%. So it's been much better than anticipated, much quicker than anticipated, the recovery. As far as the consumer, in recent weeks, the consumer got a little bit soft in terms of consumer confidence, and that's because this bill was supposed to come and it was delayed, et cetera. And you had some regional shutdowns. Some of the coastal cities had restrictions on restaurants, on schools, on business to re-shut down, and that eroded consumer confidence in the short term and probably had people pull back a little bit on spending. I think with these new stimulus checks going out in the mail, and they'll probably be received in the next week and a half or so, I think that's going to give people more confidence to go out and spend more. And we should see the spending and the confidence numbers pick up quite a bit. And particularly as it relates to that $300 billion for PPP for the small businesses, I think we're going to see quite a bit of rehiring, and that will bring a lot of confidence to the consumer. And moving forward, particularly as we see tens of millions of people start to get vaccinated over the next few months, people are going to feel a lot better that things are getting back to normal.
Okay, let's see another impact about this stimulus. How about the impact of the stimulus of the stock market and especially to the US dollar movement right now?
Yeah, I think what we're having here, short term, the stock market should continue to go up into year end. This is the Santa Claus rally period that started on Christmas Eve, and it goes through the second trading day of January. If you look back since over the last 70 years of data, on average, it's up 78% of the time, and the average return during those 7 trading sessions is positive 1.3%. So I think this just exacerbates that trend. So that's a good thing in the very short term. In the US dollar in the short term will probably continue to weaken. However, I do think in Q1 of 2021, which is just in a couple of weeks here in the middle of Q1, I think we could see some counter trend moves in the stock market, in the dollar, and in gold. The stock market, I think, as I said, if you look at the JCI in Indonesia, I've been on with you in July, in September, October. I kept saying, buy Indonesia, buy emerging markets, buy the JCI. Well, guess what's happened? It's up 60% now off the lows. But I do think the U.S. stock market is probably going to see some consolidation, maybe a little bit of pullback after this near-term bounce in Q1, which would actually create a situation with the U.S. dollar in Q1 where we do get a short-term counter-trend bounce, some strength in Q1, and then in the intermediate term, after we get maybe some consolidation in the stock market and a bounce in the U.S. dollar, then we probably from Q2 towards the back half of 2021, the normal trend will resume. The stock market will continue to go up, and the dollar should continue to weaken the second half of 2021. But just be on the lookout in Q1. We may see a little counter trend movement both in the stock market and in the U.S. dollar, maybe a little strength. And the reason that I'm saying this to you, Maria, we have a report in the U.S. called the Commitment of Traders Report. It's published every Friday. It shows how large traders are positioned, small traders are positioned, and commercials are positioned. And the commercials usually have it right. And lately, they've been getting long the U.S. dollar, which tells me that we should probably expect a short-term counter trend, strength in the dollar before resuming the downtrend that we've seen for the last couple of years.
So that you mean that the downtrends of U.S. dollars index is continue? What do you think about that?
I think the U.S. Yes, I think the U.S. dollar should continue to weaken over the next few quarters, okay. 2021 and beyond, that should persist. But I do think in Q1 of 2021, maybe over the next few weeks, we may see a short-term bounce, a little bit of strength in the U.S. dollar, a counter-trend move in the short term. Because of the way I see commercials are positioned, they're getting net long in the futures, and that should mean in the short term we get a little bit of bounce, which no one's expecting in the short term, and then after Q1 we'll probably resume the downtrend that we've seen in recent quarters.
Okay, very interesting, Thomas. But in the other side, gold price looks stagnant and it's hard to get through to 2,000 US dollar per troy ounce. What can we pay attention to in these conditions?
Yeah, well, that's interesting because the same thing is in the case of gold. Obviously, the recent trend has been up for the last number of quarters. We're seeing a little bit of weakness. And I think based on looking at how the commercials are positioned in gold, they're getting net short, which tells me that although the intermediate trend is up in gold and down in the dollar, in the short term, we could see a little bit of continued weakness in Q1, and that would make a lot of sense. I think the big holders, some of the countries like Italy and Germany, are going to have to potentially sell off some of their gold to pay for COVID-related costs. So as far as gold goes, you may see some continued counter trend, a little bit of weakness, and then I think as we get through Q1 into the back half of 2021, it should resume its uptrend and price appreciation. So effectively, I think the stock market, in the intermediate term continues to go higher. I think the dollar continues to weaken, and I think gold probably continues to appreciate if you look out 4 quarters. But in the short term, we might have counter trend moves in all three based on the positioning of commercials and based on the supply demand for the instruments.
Okay, so what is your predictions to the gold price next year? Is going up to 2,000? Is the pair possible or more than 2,000 US dollars? And how do you see the gold as an investment options in 2021 for the investor?
Yeah, I think when all is said and done by the end of the year, gold should see a 2,000 handle at some point, probably closer to the back half of the year. As far as an investment, for me, gold doesn't yield anything. So basically, what I would like to do is own the highest quality companies that have pricing power over time, because most people buy gold as an inflation hedge. But if you buy the best quality companies, they have pricing power over time. So even if currencies get weaker, they'll command more of those currencies. And there were studies, Buffett put out a study, if you put $10,000 in gold or $10,000 in the S&P 500 after World War II, over the next 70 years, you would have made $50 million by investing in the stock market over gold. And that's the kind of compounding you get by having pricing power, by having market share. So, gold may be a very small portion of the portfolio, but I like high quality businesses. We're just starting a new business cycle. We had 2 quarters of negative GDP growth in Q1 and Q2 of 2020. We had a positive 33% annualized in the US in Q3. We're going to do 11% annualized in Q4. At a new business cycle, you definitely want to have exposure to equities and high quality companies for the next multi-year bull run.
Okay, Thomas, we'll take a break a little minutes. We continue after this one dan kami akan kembali lagi usai jeda. Tetap bersama kami di Closing. Kembali lagi di Closing Bell, kami masih terhubung dengan Thomas Hayes, Chairman and Managing Member, Great Hill Capital. Okay, Thomas, we will continue our discussions. Moving on to the China economic right now, profit at Chinese industrial firms in November rose 15.5% as compared with a year earlier, according to the data released by the country's National Bureau of Statistics over the weekend. Is the signs of the recovery conditions in China?
Yeah, well, China was the first ones into the recession and they were the first ones out. So they had their epicenter in Wuhan. They had the most cases first. They also recovered the quickest, and their economic data has led the way, so much so that they'll be the only developed nation in the world to print positive GDP over 2% for 2020. They're probably going to grow 7+% in 2021. This is a very good thing for the emerging markets. And we not only saw it in industrial profits today, this month we saw it in exports up 22%. We saw it in retail sales holding steady at +5%. And we saw it in loan growth at 12%. These are all signs of very promising outlook for 2021 and beyond, both for China and for the emerging markets. Even looking at Indonesia, certainly you'll have a slightly negative GDP, -2% in 2020, but for 2021, estimates are now +5%. This is tremendous growth, and it will attract investment flows.
Okay, the recovery of China economics is a good sign for emerging market also. Is 2021 of the year of foreign investor to get aggressive for emerging market, especially Indonesia? What do you think about that, Thomas?
Yeah, I think for certain. I've been saying buy Indonesia since we were down very low. If you remember over the summer, I said buy it. And they said, are you sure? I said, buy it, buy Indonesia. So the JCI, as I said, is up 60%.
Is that still the same until now?
I think
buy Indonesia.
Buy Indonesia, buy emerging markets. And let me tell you why, Maria. There's a lot of different reasons. First and foremost, the emerging markets have recovered more quickly than the developed markets because they had it first and they're coming out first. So investors know this. They want to get exposure to Indonesia. Secondly, you're going to be getting more and more of the vaccine. You're probably going to get a lot of AstraZeneca vaccine. That will be very, very positive to get herd immunity. Third, you've got interest rates near all-term lows that favors investment flows into emerging markets. And then you've got a new administration in the United States with President Biden coming in a few weeks. That will be very good for easier trade policy, more predictable trade policy that favors emerging markets. The U.S. dollar will continue to stay subdued and will continue its longer intermediate term downtrend. That's very positive for emerging markets moving forward. And then the valuations of emerging market stocks, they're 15% cheaper than their normal discount to developed market stocks. So this is a very good thing. And with some pockets of the market becoming frothy, investment managers like myself are looking for bargains. Emerging markets is where you can get it. And it's not just buying cheap stocks, it's buying cheap stocks that are growing. And that's exactly what's happening because emerging markets earnings growth for 2021 should be north of 25%. So you can buy faster earnings growth at a lower multiple in emerging markets. Managers are going to want to do that. If you look at the positioning, Maria, of investment managers around the world, we're below our normal historic weight to emerging markets. And just to get back to that historic allocation of, call it 9% on balance, there would have to be over $350 billion of inflows into emerging markets over the next year. And I think that's actually very conservative. We're going to see that. And a lot of money is going to go into emerging markets, and a lot of money is going to go into Indonesia. It's a virtuous cycle. The fundamentals are going to start to improve. Then you're going to get multiple expansion on those earnings in the emerging markets, which is going to attract more flows. And the cost of capital is going to go down for the companies, which is going to enable them to grow even quicker. And then lastly, the reason we want exposure to emerging markets in Indonesia is demographics. You have a growing population, you have a younger population, and that's going to lead to more growth, and that's where you want to have money exposed.
Okay, so we have a lot of sectors here. What kind of the sectors in emerging market that's still interesting in 2021 and why?
Yeah, I think it's universal, not only emerging markets, but even developed markets, Maria. So if you saw in 2020, you kind of had this big move in tech. When everyone was confined at home and on lockdowns, there were very few sectors that could grow. The most popular one was tech, because tech benefited from people staying from home, number one. And number two, that's where you could find earnings growth as an investment manager. Moving forward with the economy reopening, I think capital flows are going to go from the stay-at-home trade to the reopening trade, okay? And you're going to get into more of the cyclical trades that outperform the first 8 quarters of a new business cycle. So what do we like? We like bank stocks, okay? We like defense and aerospace stocks, and we like energy stocks.
Okay, just only 3 stocks?
These are 3 sectors. So as far as banks, okay, you can see, number one, you have the yield curve steepening, okay, which is very, very important. Bank of America put out their survey recently, Global Fund Manager survey. Yield curve steepening expectations are at their highest level since November 16, August 13, and October of 2008. All were great times to buy banks because when the yield curve is steep, net interest margin increases, lending increases, and I think what you're going to see is a tremendous move for banks, which have been kind of left for dead. No one wanted to buy banks for a long time. This is going to be the year of banks. It's going to be the year of defense stocks and aerospace, anything related to flying and travel, et cetera. You want to get exposure because that's going to come back. There's global pent-up demand, over $21 trillion of fiscal and monetary support in the system globally. And as we reopen, there's going to be a huge demand for flying, and those sectors are going to benefit. And then energy. I think, as I've said, not only was I saying buy Indonesia, but I was saying buy commodities. I think we're starting a similar commodity cycle like we saw about 20 years ago from 2001 to 2007, driven by emerging market demand. You definitely want to have exposure in energy. There's been no major investment in energy discovery in the last 5 years. Demand is going to go through the roof over the next 12 to 24 months, but the supply is going to get caught. It's not going to be there. And even those managers who say, oh, we don't want to have carbon stocks, they're going to have to, because these stocks are going to start to double, particularly the highest quality stocks in the energy sector. You want to have exposure because the demand is going to be there, and they're going to pick up share as the smaller producers go out of business.
Okay, but one of the big issue right now, we talk about the energy, is talking about the mining sectors, especially coal, oil and gas sectors. Many rumors says that big investor is avoiding fossil fuel sector in the futures. They will much prefer environmentally friendly energy-based sectors. How do you see about that?
Yeah, I think that's what they want to do psychologically, but what's going to happen is we don't have enough renewables to meet the demand of the growing population and the social mobility in the emerging markets. So what's going to happen is you're going to see this demand come back in. The supply is not going to be there because there hasn't been the investment in the last 5 years, and the highest quality energy stocks are going to start to double and go up dramatically, and managers are going to say, oh my goodness, I'm missing my benchmark, I'm underperforming because I have no exposure to energy. What am I going to do? And you're going to see a huge pile into these energy stocks, irrespective of the ideology that they want to be carbon neutral. They'll have no choice to get it because that's the only place you can get energy. So the renewables will really grow over the next couple of decades to 2040 and 2050. But right now, we're still going to need particularly oil and gas. I think coal is certainly getting phased out for sure, but not entirely. But natural gas and oil, you definitely want to have exposure for the next 5 years. As the demand comes back, these sectors are going to grow dramatically. And investment managers and pensions that have been getting out at the exact wrong time, they've been dumping at the bottom of the cycle, saying that they want to be carbon neutral. As the cycle turns here, and we're beginning a new business cycle right now, as these stocks start to appreciate dramatically and the supply is not there, they're going to be minting money, and managers will have to chase up after the stocks have already appreciated 50, 75, 100% over the next couple of years. This is a great sector no one's paying attention to. I'm telling you, Maria, just like I was saying, buy Indonesia, and now it's up 60%. I'm telling you, buy energy, and 4, 5, 6 months down the road, we're going to be on, and I'm going to say, see, Maria, I said, buy energy, and you'll say, yes, I remember.
Okay,
so
specifically,
that's where the puck is
what
going.
kind of energy? Is this nickel energy, especially because the rumor of the battery for the battery vehicle for the futures? It's because we have a rumor Tesla will invest a lot of money in Indonesia.
Yeah, it's certainly mining is useful, but I want to have exposure to the global demand for oil and gas, okay? Because
Oil and
while
gas,
we're
okay.
moving in the direction, while we're moving in the direction of electric vehicles and there'll be demand for mining, this is going to take a lot of time because you need the charging stations, you need the adoption, you need all these different things to happen, and you need the resources to be mined, et cetera, which, by the way, takes a lot of carbon energy to mine the resources for the electric vehicles, which
Yeah.
no one talks about. So in the short term, over the next 12 to 24 months, I want to have as much exposure as I can to energy, oil and gas, and some mining stocks. And then as you go out and you look to the future, certainly you want to have exposure to electric vehicles, to renewables. That is the wave of the future. But in the short term, we have to meet the demands of the growing population in the emerging markets, the social mobility, the emerging middle class, and those needs and mobility are going to be met by what we have now, which is gas and which is oil.
Okay, thank you so much for your time. Sir Thomas Hay, Chairman and Managing Member, Great Hill Capital. Very appreciated to discussing with us. Thank you so much. Stay healthy, Thomas. Dan diskusi tadi sekaligus juga menjadi penutup program Closing Bell hari ini. Saksikan terus CNBC Indonesia di cnbcindonesia.com, transmisi channel 805. Anda juga bisa menyaksikannya via UCTV di Hindi Home. Saya Maria Katarina pamit. Pastikan Anda jaga kesehatan diri Anda dan juga keluarga. Dan terus saksikan CNBC Indonesia Beyond Business.